And I think we'll be focusing now on the cost of compliance, which is an issue that's addressed, I think, by all regulators and licensees. And it's a universal issue with respect to what it means to be in compliance and what it costs to be in compliance. Okay, so back in 2017, Mohammed bin Ibrahim, who's the governor of Central Bank of Malaysia at the time, had a keynote address at the International Conference of Financial Crime, and he suspected that many firms were spending up to 10% of their budget, of their revenue, on compliance, an amount which he indicated was not insignificant. And indeed, it's not. The question is that going to be the standard going forward? And it appears that the expectations are that the more you make, the more you should spend in compliance, and that the percentage of your revenue dedicated to compliance should be appreciable. Right. Well, it's you know, the compliance cost, it generally drives de-risking. I think the next couple of sections, or rather the next couple of slides, we'll look into how the cost of compliance, but also the expectation of revenue in a correspondent banking relationship may trigger and be a factor in de-risking. The fact of the matter is that because of the risk involved, there is naturally a risk-reward analysis with respect to correspondent banking relationships, and many banks in the U.S. in particular have taken that approach. And at the end of the day, the risk and the headaches with dealing with regulators outweighs the incremental revenue generated by those relationships. And unfortunately, the result is de-risking. Now, obviously, those are factors that affect not U.S. banks, but globally. The IMF has chimed in as well with respect to how profitability will drive de-risking. In particular, they indicated that while factors leading to global banks' withdrawal from the correspondent banking are multiple and interrelated, these are ultimately individual business decisions. And that is true. I said earlier in my previous presentation that banks want to do business. Banks want to make money, but they are, in fact, overseen by regulators that express concerns, and that pressure has to be taken into account. And they look at the reward of continuing in a line of business with the possibility of a sanction or a fine or a consent order. They also look at reputational risk. So all of these things combined end up not favoring the maintenance of a correspondent banking line of business, and therefore they end up eliminating it either entirely or significantly. And again, it becomes a risk reward, high volume, low return, and a balance sheet intensive business. That's what correspondent banking is. It's high volume, it's a balance sheet driven type of activity for the banks offering the service, and the returns are low. Now, having said that, let me just say that we're low for who, right? Low for who? Is it low for Bank of America and Citibank and Chase and Wells Fargo? Yes, you better believe it. It's low for them because these are multi-billion-dollar banks where any line of business in and of itself is not going to make a dent in the revenue of these banks. So what we have seen, and what I have seen in terms of helping foreign banks establish banking relationships in the US, is that we're looking at mid-tier banks and smaller banks offering correspondent banking services, where the level of income is more significant for those banks, and the risk-reward analysis ends up being more favorable to maintaining and developing those types of relationships. And I've, you know, and you as regulators and some of you as banks have probably caught on to that and may have already been engaging with smaller banks in the US that are slowly but surely coming into this line of business because it does generate fees for banks. And if they can do it appropriately, the rewards are more significant than the bigger banks in the US. And again, the risk-reward ratio of high potential costs and low profitability is a key driver behind the decline in correspondent banking services. So you had the IMF indicating that, you had the World Bank indicating that, but any person involved in the industry knows this. It is what it is. These are studies that have been conducted in surveys. And clearly, when you're looking at the bigger banks around the world, one line of business is not going to make or break their balance sheet. So if there's undue pressure or too much of a reputational risk involved with a line of business, they would rather forego that than to deal with it. It's just the reality of how they operate. Thomson Reuters came out with the G-SIFIs. If you know what the G-SIFIs are, these are the Global Systematically Important Financial Institutions, the G-SIFIs. Basically, those are the biggest banks in the world. They came out with a survey, and the survey has been the case with previous years, is that the banks are de-risking because it doesn't make any economic sense for them to deal with the risks involved. And if we go to the next list, we'll see what the survey of Thomson Reuters carried out. In the next slide, please. So now this is from 2016, and then there's a follow-up slide to this one for 2018. But let's look at what Thomson Reuters picked up as far as the cost of compliance moving forward. This was 5 years ago now. At the time, they indicated that 69% of the firms were expecting regulators to come out with even more regulations, and that's the way it's been. The trend has been more than 1/3 of the firms are spending a whole day related to a compliance issue. Over here, you see 60% of the respondents expect personal liability. Remember, I spoke in the previous session about the MoneyGram executive being caught up personally in a compliance issue. Well, it's a reality for many banks that this is the issue. Look at the bottom one here. Only half of the respondents expected to spend less than an hour a day on compliance issues. So if you have 8 hours in a day, that's 1/8 of your time. Only half were expecting to do that. The others were expecting to dedicate substantially more time to compliance, and with the increase comes cost, obviously. So that's really the takeaway as far as that's concerned. Also, 1/4 of the firms are outsourcing their compliance, which also increases the cost of compliance. That was in 2016. Now in 2018, Thomson Reuters comes out with another survey, and here we touch upon something that I actually highlighted earlier, well not earlier, but later on in this presentation, that there are more challenges than just AML, ATF compliance. And you also have data privacy and some other risks, which we'll highlight later. But that's also an issue driving up the cost of compliance, because when we talk about compliance, it's not just limited to AML and ATF at a bank. There are consumer privacy issues, there's data breaches, cybersecurity, and we'll get into that briefly in the next few slides. Nearly 2/3 of those surveyed expected an increase in their compliance budget, and why not? The cost of living goes up, so the cost of compliance goes up. 1/4 of the firms will still outsourcing. Over half of the respondents still expect their personal liability to increase. 41% were expecting to spend more time assessing fintech and regulatory tech solutions. 43% were expected to grow their compliance teams, and I don't think that's changed. If you surveyed them in 2020, you would still expect an increase in compliance, moving forward. Interestingly enough, my experience has been through the pandemic with financial institutions, even though there's been cutbacks in many financial institutions just because of the slowdown in the economies. I have not seen too many. Quite frankly, I don't think I know of any client in particular that has cut back on compliance. So that should tell you something, that the cost of compliance keeps increasing, and maintaining a staff is important. Okay, the last one I just wanted to point out to you, 2/3 of the firms expect the cost of compliance, senior management, to increase. And again, that's consistent with just normal trends, but also with the need to fully staff and apply appropriate resources to compliance teams. So we talk about compliance cost, and this is where we get into other areas, and in the next screen, you'll see what I'm talking about. Yes, so it's not an isolated cost, right? Compliance is not just AML or ATF or CFT, as we call it sometimes. There are other areas where the banks need to focus their compliance efforts, and it has to do with reporting, not related to AML or CFT, but just general reporting, banking reporting, other types of risks associated with the bank, credit fraud, cybercrime, consumer protection, data safety is a big one. Here in the US, we had a petroleum pipeline hacked by some Russian hackers who ended up installing some ransomware and ending up with $5 million in cryptocurrency to pull out the virus, which is very scary. But in the United States, I mean, that's something that can happen anywhere, and banks are dealing with hacking and phishing schemes. So that data safety, cybersecurity is very important, and that's part of compliance. So when you have an overall compliance team, it's not just limited to AML, CFT. You also have fair lending, corporate governance, and the like. So we get that, and we understand that, and regulators know that. But having said that, when it comes to correspondent banking relationship, I don't think a bank in the U.S. cares too much about how you're dealing with your credit card fraud locally, as long as whatever transactions you process through the bank in the U.S. Deals adequately with AML and CFT. So what about the U.S. banks? Banks are, again, deciding whether or not to take on the banks abroad. They are looking at a risk reward. I had mentioned earlier that I've worked with banks and am continually working with banks in the U.S. that are smaller. So they're not the G-SIFIs. They're smaller banks, many of them you haven't even heard of, in states that you probably have not heard of or certainly haven't visited. But these are banks that can offer correspondent banking relationships. They offer an entry into the U.S. financial system, and they can provide all of the services that a major bank can, whether it be wire transfers, international letters of credit, credit cards, whatever a foreign bank, payments, whatever a foreign bank needs. These U.S. smaller banks can engage in those types of transactions. And I would suggest that should be a target for discussion as they look to expand locally in the U.S. and let other banks around the world know that they're open for business. Having said that, because they are not traditional correspondent banking service providers, they generally need to get not so much permission, but certainly let their regulators know that they're thinking about getting into this line of business, and to make sure that they are equipped with dealing with the regulations and the compliance that is related to maintaining those accounts. Typically, when they do get into these lines of business, they are quickly advised that it's not one person show, that a correspondent banking relationship line of business, a CBR line of business, involves a team. Now the team can be, depending on, if you're going to have one account, I mean, you don't need 10 people, but as you expand the relationships, it cannot be limited to just a one-person operation. And that goes from compliance also to personnel actually servicing the CBR relationship. One of the things that I've noticed as well, as I've worked with even the smaller banks in the US, that they'll take a look at the ratings of countries as it relates to corruption, as it relates to money laundering risks. So in the United States, the State Department annually publishes AML risks for all the countries in the world. And that is a go-to source for many banks in the US. So if for any reason a bank finds itself in a country that has a bad index for corruption or transparency, or a bad index for money laundering risks, that may be a definite no for a bank looking to establish banking relationship. Now, of course, that seems unfair because, you know, a bank may have all the controls in place, may be well equipped to deal with the U.S. financial regulations and not be a problem to a U.S. bank, but they just happen to be in a country that is still getting its act together. So that factors in to either de-risking or maintaining and opening new accounts. And again, even for the smaller banks, and I deal with banks in states other than New York, Florida, or California, or Texas, which are the larger states. But I've come across banks in states like North Carolina, Arkansas, Nebraska, Kansas, that do offer banking relationships to foreign banks. And these are banks typically not in urban centers like New York City or Chicago or LA, Los Angeles. But again, it doesn't matter where the bank is. If they can offer the service and they have in place good programs and risk controls, then they can certainly provide financial services. And again, correspondent banking services may not be a big deal to the bigger banks, but the fee income generated by these relationships for smaller to mid-tier banks is more significant. So the risk-reward analysis tends to favor actually creating and maintaining these lines of accounts. So the cost of compliance directly affects the profitability of the relationship. We take into account that low profitability could be a phenomena, and it is. But again, low profitability to who? To the big banks? Yes, if you're surveying the bigger banks, the G-SIFIs, that's the answer you're going to get. When you survey the smaller banks, profitability still is an issue, but the analysis tends to favor more maintaining the accounts because it's more significant to the smaller banks. So what are the international regulators and correspondent banks expect from their counterparties? So I touched upon this in the previous session, and we'll reiterate it again. We're dealing with two animals here, right? We're dealing with the U.S. bank, and we're dealing with the regulator. And the de-risking or non-de-risking of accounts is directly attributable to how these two animals interact, right? If you get pressure from the regulators onto the U.S. Banks, then they are definitely going to de-risk. And they've been de-risking for a while, to a point now where, as I said earlier, there is no more de-risking. They've done all their de-risking. Now it's a matter of trying to establish relationships with either those banks again, or with new banks. And some of the things that we should take into account are on the following slides. Right, so about 5 years ago, the Treasury Department and the federal banking agencies came out with a joint fact sheet, which was anticipated and I think, quite frankly, needed, because again, you had all these supervisors, both federal and state, not necessarily knowing how to deal with correspondent banking relationships, and local banks in the U.S. that were servicing them. So it was good that they came out, and they came out with some rather positive guidance, and among them were the following. U.S. depository institutions that maintain correspondent accounts for foreign financial institutions, FFIs, are not required to perform due diligence on the customers of the FFIs. So this is the top tier agency in the United States, the Treasury Department, along with the banking regulators, state and federal, mostly federal actually, putting to rest this notion that if you are a correspondent bank in the US and your respondent has these customers, that somehow you need to do due diligence on those customers. And what's clear from the guidance is that that's not the case. Number one, it's not practical. And it just wouldn't be effective. What the US regulation calls for is that you do a risk-based approach to see how your respondent bank, the bank in the foreign country, does their onboarding. You sample some of their KYC files. Periodically, you ask for information on a particular customer that has done a transaction. And that should be sufficient to give you an understanding of the KYC program for that respondent bank. The guidance also indicated that U.S. depository institutions must establish appropriate, specific, and risk-based due diligence policies, procedures, and processes that are reasonably designed to assess and manage the inherent risk of the correspondent banking relationship. Again, if you have one account, I don't have to do 20,000 things, right? But if I have, a dozen accounts, then yes, my program has to be more expansive. And the guidance was addressing that this should be risk-based, and risk-based oftentimes relates to how many of these accounts you have. Okay. Now the FFIEC, which again is the combination of all the US federal banking regulators. As I mentioned earlier, we also have state banking regulators. We have 50 state banking regulators. At the federal level, we have basically the Fed, the Office of the Comptroller of the Currency, the FDIC, the NCUA, which supervises all credit unions, and the Consumer Financial Protection Board, which was a creation after the 2008 financial crisis. So all of these federal agencies oversee the financial activity of banks and non-bank financial institutions. So what are the policies and procedures that a U.S. bank engaged in a correspondent banking relationship should have? Well, they should specify what the account opening procedures are, what type of documents, what type of businesses are you going to provide, business lines, etc. You should assess those risks using well-documented methodologies, and you'll be surprised how difficult that may be for some banks. They don't know what a risk matrix is sometimes. You have to develop it for them. But once you get it done, it's rather straightforward, and all you need is time and resources to implement it. But you clearly, when you're going to take on a correspondent banking relationship, you have to know something about the bank in the foreign country. You have to know something about the foreign country itself, its reputation, its regulatory scheme. And of course, you have to know something about the customers of that bank, because by definition, they almost become customers of yours, and that's where the risk comes in. The guidance from the FFIEC also indicated that we have to understand the use and purpose of the account, who's going to use it, how often, what's the anticipated level of activity, etc. Understand if that particular bank has other correspondent banking relationships, which may enter into the services and the transactions that flow through the U.S. bank. And I'll show you a slide in a moment that addresses that. Conduct adequate and ongoing due diligence of the foreign financial institution. It wouldn't be any different than a customer. What I tell my clients in the U.S. that are banks, you treat a foreign as a customer, and you have to do the due diligence on that customer. And there are different guidelines for different types of customers. You have, as I mentioned earlier, if it's a car dealer, well, this is what you should follow. If it's a church, this is what you should follow. If it's another bank, this is what you should follow. And the ongoing due diligence is something that was highlighted by the FFIEC. Also maintain accounts in the U.S. These are, by the way, I highlight these because these tell you something about the thinking of the US regulators, right? They indicate that foreign financial institutions maintain accounts at US banks to gain access to the US financial system and to take advantage of services and products that may not be available in the FFI's jurisdiction. I mean, just the wording of that, right? Gaining access, as though it's like some forbidden fruit or something. Take advantage of. I think the wording could have been nicer, but this is how, you know, these relationships are viewed, that you're coming in here for illicit purposes almost, when the reality is that the world has become a global economy and these types of relationships are necessary. Yet this is the actual wording from the FFI IEC policies and procedures. They also indicate that some foreign financial institutions are not subject to the same or similar regulatory guidelines as the US banks, which is true. But they also put, and this is in their wording, it is undeniable that foreign financial institution correspondent accounts have been used by drug traffickers and other criminal elements to launder funds. Well, yes, that's true, but also US banks has been used for that. All right, so again, perception, this is a federal agency, a combination of federal regulators issuing these policies and procedures with this wording. So you get a sense of what the US banks have to deal with. These are the regulators they have to deal with. Yeah, well, they also indicate that, you know, because of the funds and the volume of transactions, US banks may not be adequately staffed or familiar with the process. Without adequate controls, we may deal with nested accounts, which again, that's one of the main things I advise banks on when entering into correspondent banking relationships. Be careful that the respondent is not servicing other banks that you may not know about, or servicing other non-bank financial institutions that you may not know about. It's not illegal. You can certainly have it, but it needs to be disclosed and it needs to be monitored appropriately. And the FFIEC guidelines point to that risk with respect to nested accounts or pay-through accounts without the US bank knowing about it. So this is the slide I mentioned a moment ago that I wanted to discuss. And that is, when you establish a banking relationship for a foreign bank in the US, you may not be dealing with just that bank, right? So if you have foreign customers at foreign bank A, as depicted here in this slide, that foreign bank A may process that transaction from the originator through its US correspondent. That US bank may actually have a relationship with another US bank. And that US bank may have a corresponding relationship with a foreign bank B. So it's not always a singular, you know, a two-way relationship. When you open up a correspondent bank to a respondent bank outside the US, you're essentially opening up the services to a myriad of transactions, including transactions that may involve other players. So these are types of risks, if you will, that correspondent banking relationship lines of business need to understand and address appropriately. Because it's not just servicing one correspondent bank, but you're servicing the lines of business that they bring into you, which is good, by the way, because, you know, that generates fees for the bank. And again, all of this has to do with how do you adequately control those relationships. Now, here's, I don't know if you guys are familiar with the term, he didn't get the memo. Okay, so it's a saying when there's a directive from higher ups, and oftentimes that directive is memorialized in a memorandum. And then the person that's not following the directive obviously didn't get the memo. So that's happening in the US more often than you think when it comes from what agencies are saying as far as how to deal with correspondent banking relationships, and what the field level examiners are actually implementing when they go out and examine banks and go out and render reports of examination. So there's a disconnect, and I wanted to highlight this particular problem. So The U.S. banks, right, take the position, given what the financial agencies are saying, that there's no need to file suspicious activity reports on respondent customers. And that is true. FinCEN, which is the intelligence agency, the financial intelligence unit in the United States, has indicated you don't have to file suspicious activity reports on the activities of your respondents' customers. You definitely should take into account that activity when deciding whether or not to maintain the account or whether or not to put restrictions on the account. But you don't have to file suspicious activity reports. That comes from FinCEN. Yet, when being examined by field examiners, banks in the US get chastised for not filing reports on the activity of a respondent bank's foreign customers. It happens all the time. The CBR, the correspondent banking relationship line of business, should be examined and evaluated by regulators based on size and volume of business. This is what IMF says. This is what the World Bank says. This is what the US regulators say at the agency level. It's risk-based. It's a risk-based approach. So if I have one correspondent banking relationship, why are you making me do 25,000 things? That's what examiners do. They don't take into account the risk. Oh, you have correspondent banking. Oh, wait a minute. Let me bring out this volume of enhanced due diligence that I'm going to make you go through an additional 2 weeks of examination without looking at the fact that, listen, I just have that account so that he can pay credit cards for his customers in the US. We're not doing any wire transfers. We're not doing millions of dollars in letters of credit, but this is a problem. The bank position is that the CBR line of business can be merged into and managed by staff in other lines. No, the field examiners say, no, you can't do that. You have to have a dedicated staff for that. Again, it goes to risk. If you're going to have a dozen accounts, yes, that's going to merit its own team. But if you're bringing on 1 or 2 accounts and you have a team of bank managers and you have sufficient compliance staff to deal with those 2 new accounts, there's no reason to engage new staff. Yet field examiners say the opposite. The travel rule is satisfied with inclusion of names of related parties to a transaction. The travel rule, of course, being the information captured in a wire transfer. Field regulators say no, the messaging may require additional information that is meaningful. So, I mean, you want more information than the customer's bank, the beneficiary's bank, the beneficiary's name. So they want more information. They oftentimes want information about the nature of the transaction, which is not required. These are the same regulators that work for the same agency that have indicated that's not a requirement. So it's a question of, the memo, not getting down to the field examiners. Ultimate beneficial ownership information can be obtained by the respondent based on what the correspondent bank tells you. Nope, field examiners say you have to do more than that. You have to confirm what they're telling you is true. Again, this is not all the examiners, but you get some examiners that go in there with this thinking, the ones that did not get the memo. And lastly, US banks rightfully have the position. You cannot have nested accounts if the bank has knowledge of how a respondent bank is working. So, as I said earlier, if a respondent is going to be servicing other banks and you know about it, and you've taken adequate measures to address the eventual interplay between those two, it's not a nested account. Nested accounts, by definition, involve a lack of knowledge on the part of the correspondent. That's not how examiners are taking it. Some, anyway, in the US. So, again, feel sorry for some of these US banks that they deal with this, but this is what they deal with, and it has an adverse effect on correspondent banking relationships. And again, so I want to have some contrast between international bodies that have come up with recommendations and also the FFIEC, which is the conglomerate of US federal banking regulators. The Basel Committee in 2017 indicated that the customer base of a respondent, right, so a foreign bank, their customer base, including its customers and their locations, and the ability to obtain the identity of those parties was replaced with a recommendation to do a general risk assessment. So again, Basel Committee is in line with what FinCEN has even indicated in the US, which is if I'm a US bank, I don't have to do due diligence on my respondents' customers. What I have to do is take a global approach to risk rating the relationship, knowing, and it can be as simple as, listen, what percentage of your customers sell cars? What percentages of your customers are going to do international wires? What percentages of your customers are import-exporters? That starts giving you a feel for the type of relationship that you're going to have. And the certifications that come with that, which are still required in the US, you have to have a certification from your respondent bank, basically stating that they have taken into account all these controls that are required. And there has to be a level of trust. So, I mean, some things you're not going to be able to prove 100%, but risk rating helps you address the immediate concern that you know your customer and their transactions. Basel also indicated that a downstream clearing framework allows for regional banks to serve as intermediaries. Again, I think that the Basel Committee understands that we're in a global economy. And we've been in a global economy now for some time. So for us to move on, we have to be on the same page. FFIEC on the right side of this screen is focusing on other things and perception. So CBRs are inherently high risk. That's a category that automatically requires enhanced due diligence by examiners. They're concerned with shell banks. They're concerned with nested accounts and pay-through accounts. And again, all of that can be detected, but the constant focus on that, as opposed to focusing on the controls in place, end up enhancing de-risking as opposed to minimizing it. So managing the expectations and the minimum requirements based on everything that we've been discussing. Okay, so it's not a surprise that one of the things that we have to do, especially for those smaller banks that are getting into this field and which I work with often, is make sure that you have full compliance with the onboarding process. A written agreement should always cover the relationship. And the written agreement often denotes compliance obligations on both sides. We use the section 313 and 319 from the USA Patriot Act. These are the correspondent bank certifications. They're done yearly. And essentially the respondent bank in the foreign country indicates that they are in compliance with US regulations. Oftentimes I recommend this, and US banks often require it. If you're going to be in the US as a respondent, having a correspondent banking relationship, you may want to look into having a representative agent in the US. If for anything else, in case you need to have someone receive your correspondence locally, or if there's a subpoena from a court or any legal process, it's always good to have an agent or an individual that can receive those notifications on behalf of the foreign bank. And believe it or not, all material should be in English. For those attending here, that may not be a big issue, but when I'm dealing with banks in Latin America or in Europe, we get all these documents in a foreign language, and all of it needs to be translated to English, all of it. You have certificates of incorporation, licenses, compliance manuals, KYC files, everything needs to be translated so that US regulators particularly can understand what level of due diligence is being performed. Sharing information is important. In the US, under the Patriot Act, we have section 314B. And that allows information sharing between financial institutions. I understand that that's not always the case outside the United States. In fact, in many countries, it's actually prohibited for financial institutions to share information about their customers. However, in the US, it is permissible and actually expected. So I think that knowing that information is important, because if you are a respondent bank, you may have the U.S. bank asking you for information about your customers, which normally you may not be even allowed to share with anybody else based on local jurisdictions. And that's something that regulators in foreign countries need to understand too, that when their licensees are working in the U.S., there may be a need to share information. Compliance officers have to be independent. Independent reviews should be current. Reciprocal due diligence is important. So it's not only the U.S. bank asking for due diligence information. Foreign banks, and I tell this to foreign banks all the time, you can impress the heck out of U.S. banks by reciprocating the requests. Let them know that you also have a compliance program and that you want to know something about them and you want to get information to satisfy your internal KYC and due diligence requirements. And of course, as you monitor transactions, there should be suspicious activity reporting. I mentioned it in the previous session. The lack of reporting, again, may not indicate that you have a bad compliance program, but it does raise an alert for a bank analyzing your program that you have never filed an SAR, or that you file it very infrequently for the level of activity that you engage in. So that's something that should be kept in mind. Next slide. Oh, next slide is a thank you. Well, I appreciate it. Thank you. I think it was Maria helping me out there. Yeah, I don't know who it was, but not sure who's next. But again, it's been a pleasure. I hope to speak to you guys again at some point tomorrow. And I hope that this has been informative and fruitful.